Good morning. Welcome to YX Insights. Today is December 19th, Friday before the market open. Today is the triple witching day. A lot of rolling contracts, probably a lot of volatility. We've had the non-farm payrolls and the CPI reports already. So the macro data have finished for the year. Unemployment rate is now at 4.6%, and it has been going up pretty steadily every single print in the past 5 or 6 months. At the same time, CPI has declined. So the headline CPI is only 2.7%. And so it's pretty good that it's below the 3% mark and it's headed towards the 2% goal. That is actually measured by PCE, but the Fed takes CPI very seriously. What I want you to see is in this larger picture from 1996, every single time that the unemployment rate started moving up, we tended to get a spike subsequently. So this was true in 2001, that was the dot-com bubble, and then the financial crisis. Employment rate spiked rapidly in 2008. COVID, that was more of an exogenous event, but if we look at the slope of this unemployment rate chart, it does signal danger compared to dot-com and great financial crisis. I think the Fed was right to cut rates in December, and they should continue a dovish stance, even though we are more or less at the upper bound of the neutral rate. With the average hourly earnings steadily coming down as well, so that restrains the services sector inflation, and oil prices coming down at the same time, which it has done, and is likely to continue doing so in 2026, we will have a rapid deceleration of inflation. And I think the Fed could achieve its goal much sooner than the market currently prices. And when you have a labor market crisis, when people are coming out of jobs and their purchasing power reduces, we are going to see a demand side shock as well. And I do think the Fed needs to probably step in at some point later next year with more aggressive rate cuts than what's currently projected, and potentially QE. The Fed has a dot plot that is fairly restrained on the rate cuts. It looks quite neutral, but the market thinks we're going to get at least 2 cuts in the next 12 months. So we have a terminal rate around 3%. And if you think about inflation potentially dropping below 2.5%, or even getting to the target of 2%, that is still 0.5% to 1% real interest rate by the end of the year. So it's by no means a loose financial condition, even if we get to the 3% mark. In the near term, I want to bring your attention to the Treasury General Account balances. The TGA balance, you can think of it as the government's bank balance at the Fed. When this balance goes up, for example, from tax receipts, this means the government is holding money in its bank account and not spending it in the real world. And that money is not flowing into the real economy, the bank reserves, or the financial markets. When this balance drops down, that money is flowing from the Fed reserves to the bank reserves, and that is a liquidity boost to financial markets. And you can see this through the SOFR versus EFFR spread. When the TGA shot up due to the government shutdown, so they can't spend the money. The liquidity got so much worse that banks had to borrow at an extra 20 basis points to even 30 basis points around the month end to fund their overnight cash positions. And this is a primary motive that the Fed is starting to buy the short-end treasury bills at $40 billion a month. So looking at now, the beginning of the week, we actually had a big increase in the TGA balance after a smooth 2-week declining trend. And that did constrain the market liquidity quite a bit. We saw a sell-off on Monday, and we also saw the secured lending rate spiking on Monday as well. But it has come down now. So 5 basis points, I would say, is probably within acceptable normal range, is on the lower end of what we're seeing since September, although ideally we want to see the spread being around zero, of course. So I think overall, that TGA balance has come down again since the beginning of the week, and the secured lending rate is also coming down at the same time. That should set us up well for a rally towards the year end. Looking at SPY, the S&P 500 ETF, I have been expecting a wave 2 pullback in this rally that could end anywhere between 50% to the 78% retrace of this wave 1. And that would bring us to the 660 to 670 level, where there's a lot of volume as support as well in this region. So a lot of dip buyers would be coming in here. And I understand that when this sell-off starts to happen, the market is very fragile anyway, and it's very easy to fall back into a fearful mode. But if you look at the absolute levels, we're still hanging around the 50-day moving average again. We took out the old all-time high only a week ago. So this is a very normal pullback for wave 2. And typically wave 2 is still in the disbelief zone where people are still a little bit skeptical of the rally. And we could see a little bit more retrace, but overall, this drop here has sufficed my wave 2 expectation. So we could see a deeper pullback towards 660, but I'm not going to be really waiting for another aggressive drop before I'm comfortable. So I still have this bullish thesis in place for the next 5 waves and heading into above 700 in early next year. And of course, if we drop below this danger zone highlighted in red, where there was previously a lot of support, we could be looking at a lower low in wave C of 4. So this could be an slightly expanded flat to complete wave 4. But for now, that is not my primary expectation. So I do think things are looking favorable for a year-end rally. For QQQ, I know it is very tempting to look at this as a potential head and shoulders, but the head and shoulders pattern is really a concern if we break the neckline, which would be around the 580 level. For now, this wave 2 has dropped just around the 61% retrace of this wave 1, which is a very standard level for wave 2 pullback. And it could pull back a little bit deeper to 590, but there is a lot of volume here for potential dip buying as support. And I do expect us potentially heading towards the very high 600s or even 700 by early next year. IWM. So you may have noticed that I haven't got a smaller degree mapped out because we've only had a 1 move up in this wave 1 and a very shallow drawdown at the moment. It's only retraced less than the 38% of this initial rally. So there is definitely room to retest the 50-day moving average. There's a lot of volume here, and I think we could potentially find the support around this region and heading up. But if this is a 1-2 setup here, then this wave 5 is potentially much higher, or even 300 level. So once this wave 2 pullback completes, we can map out the rest of this large degree wave 5. The 30-year yield, I think, is quite interesting. We had an inverse head and shoulders that broke the neckline on the upside. So I do think this is potentially a wave A and B, and now wave C of this wave 2. And this wave C can reach 4.89% for termination. So still, we are seeing a lot of upside momentum. The RSI is also trending up. So I'm not going to be aggressively buying TLT unless we are quite comfortable that we've topped. So that's not yet the case. And our machine learning signal has been on risk off for TLT. So signal of 0, either sell or stay in cash for now. And that's been for a while. So I'm also waiting for that signal to turn back on to risk on before I get aggressively bullish on TLT. So TLT is the actual bond price, and we're looking at potential wave C here. That could still reach 86 on the low side, or even retest the 200-day moving average before heading up. So I think for now, this downtrend is still very much in place. I'm not going to be aggressive on the dip right now. However, if you're a long-term holder, the 30-year yield at 4.8% is pretty attractive. It's not that much lower than our target zone of 4.9 anyway. So if as a long-term bond holder, if you're not doing the tactical buying and selling here and there, I don't think this is an attractive price. So I do think overall the level is pretty good for long-term holders. Bear in mind that when you are buying TLT, you're not just buying the rate cuts. There is an element of term premium, which means the buyers need to be compensated for the potential changes in the rate interest rate in a long duration bond, so in the next 30 years. And that term premium can fluctuate quite a lot depending on how aggressive the government is issuing debt, the budget planning, etc., and just the general market sentiment as well. So US oil, my read is that it should be trying to challenge the low 60s next. We are in a larger degree wave C, and we could be potentially completing wave 5 of this wave C. Overall, the technicals actually do align pretty well with the fundamentals as well. For the fundamentals, there is a big surplus of oil production coming from the OPEC plus zones, as well as North American producers like US and Canada. So in terms of the global demand, that has been far outpaced by the global supply for a while now. So that's why you see that even though we have intermittent spikes during geopolitical risks in the Middle East, overall the trend has been down since the summer. Looking at Bitcoin, my bullish expectation would be we've bottomed here and we're looking at 5 wave up from here. So this is a wave 2 pullback, retesting this trend line. Even though the market does feel very nervous, we've actually held this 85k level pretty well in the past week. So I think if this wave 2 1-2 setup is in play, we're looking at a wave 3 above 100k for sure, but probably below 110k. There is a chance that my bullish thesis is wrong, and we can get deeper retrace in this wave C. So in terms of this running flat, higher wave B than the beginning of this wave 4, but wave C could trade all the way down to the 100% of this wave A level, which is 74.6K. So this chance, we haven't crossed that bridge yet. If this doesn't hold, then of course this will be very much in play, and we need to watch out for this. Ethereum, I want to look at the medium-term chart a bit more here. It's quite a messy chart for Elliott wave analysis, partially because crypto is very new, and the Elliott wave analysis is very good for mature, large asset classes that's driven by crowd psychology, whereas crypto is like a new commodity with very sharp upturns and downturns. It's a bit harder to apply the traditional technical analysis for this. So it's very heavily subjective, and do take my analysis with a pinch of salt as well. The chart is ever evolving, so we will just have to update when we get new data. So over here, I do think we could be in an expanded leading diagonal here, where we have wave 1, 2, and 3, and 4, but this 4 heavily overlaps with this wave 1. We are getting higher highs and higher lows, but it's not a clean channel. So each of the 5 subwaves is divided into A, B, C, rather than the 5 subwaves that you can typically see in an impulsive move. So I've mapped out all the ABCs here. What I'm thinking here for in the near term, that we are potentially in the wave B downturn out of this final wave 5. Wave B could end around the 50% retrace, but also, of course, a little bit deeper, where there's a volume profile here around the 61% retrace. But back in this wave 3, this wave B was about 50% retrace. So if we are mapping out a similar level here, we could potentially bottom, maybe a touch deeper, but ultimately we should get wave C towards the 10K mark. I do think this is a high probability event, even if we get a deeper retrace in the near term. Solana hasn't had the amount of institutional interest or backing as Ether in terms of the tokenization narrative. And we could be looking at a head and shoulder pattern over here, and we're holding just above the neckline. For now, if we have a bullish thesis with the rest of the crypto market, we could be looking at ABC up here for this wave 1 and ABC down. But of course, there's a possibility that we actually do break the neckline, and that becomes more of a large degree wave C of this wave 4. But I'm just very cautious here. I would be only really interested if we can get a sustained 5-wave up movement, at least above this 140 area, where there's a lot of volume profiles with potential resistance. But for now, we're just closely watching how this pattern unfolds. XRP, very volatile as an asset. It swaps the 3rd place with Solana in terms of the trading volume. And we are looking at a potential wave A back in April, wave B going into July high, and currently wave C of this wave 4. And because this wave A, B has expanded, so we're looking at potentially a running flat or expanded flat that could end around the same region as wave A or even slightly below. So again, not turning too bullish or aggressive too soon. I do think when the market recovers, it's prudent to go with the likes of Bitcoin and Ether before getting too far out of the risk curve. Coinbase, on a relative basis, is actually being more bullish than the actual cryptocurrencies themselves. We are at least not getting a steeper drawdown as back in April. However, looking at where we are now, I think this is a similar place to where Robinhood had after it reached the post-IPO high. And so what Robinhood did, which I will show you in a second, is that it dropped by about 50% from 64-ish level to 30 after it recovered the high, and then before heading to where we are now at 117 today. The optimistic scenario is that we get a wave 2 pullback and right now, and we are looking at 5 waves up towards the 360 level to really just kickstart this larger degree wave 5. And this large degree wave 5 could head towards 750, which sounds aggressive, but just bear in mind, Robinhood went from 30 to 120, and that's a 4x. So we're looking at 250 to 750, that's a 3x. It is actually achievable, and Coinbase is now expanding into all sorts of stocks trading and prediction markets just beyond the crypto asset class. I do think this wave C has sufficient length compared to this wave A. It's stopped around 120% of this wave A from the wave B high. So I'm not too worried that it could drop that much lower. And of course, the bearish scenario is that we get a gap fill here towards 210, which is about another 10 to 15%. But I wouldn't expect the price to go much further than that on the downside. Robinhood, so this was what I was talking about earlier. After a 3-year round trip towards the IPO high, we had a 50% drawdown from this 63 level to around 30 level before making a run to 120. So that has been a 4x from this April low. Pretty incredible. Now, on the smaller degree, you could argue this is 1, 2, 3, 4, and 5 wave 5 has topped. But looking at the broader market, I do think there is a good chance for one more high. And given the shape of this final wave here, that could be an ABC here, an ABC down. And we're looking at a ABC in wave 3 of this wave 5. So an ending diagonal again. And in the near term, we could be challenging the 150 to even 170 mark as the wave C of this wave A. Strategy, MSTR, this wave 2 retrace is pretty deep, and it could be looking at a new low for this wave C. So this is why it's better to wait for all 5 waves of the initial rally to manifest before getting very aggressive in terms of risk. If this is a wave 2 pullback, i.e. this wave 4 holds from December 1st, we could be looking at 5 waves up that reaches the resistance area around 300. There's the 200-day moving average, which of course will be coming down during this rally. And there is a big volume profile here as a selling pressure. So we are just waiting to see this potential path to manifest, and then buying the next dip is potentially a good strategy. No pun intended. BMNR, I think the original thesis of this being a wave 1, 2, and 3 is pretty much invalidated. Instead, we're looking at this being a larger degree wave 2 pullback that is now challenging the beginning of this rally. The bullish scenario is for this low to hold, and we're looking at 5 waves up, with waves 3 potentially moving above this volume supply over here, and then with 5 decisively moving above the August high too. I do think this could take some time to manifest, so it's not a straight up path, but it's the price levels that matter for the moment. And within the wave 3, we could reach the initial resistance around 50. That is a challenging zone, especially given a lot of shares traded back here between August and October in this region. Sharp link, a bit similar in this case. This could be a wave 2 pullback, but it's getting quite steep now. In the optimistic bullish scenario, we could be challenging this volume region around 16 next in this 5 wave up. Again, I do think given the risk off sentiment in crypto, it's best to wait for this 5 waves to complete and then buy in the next pullback instead of getting extremely aggressive over here trying to catch the bottom. Gold has been surely but steadily reclaiming this all-time high here. My primary expectation is that we are in a wave 3 of this wave 5, and that could target 4.8 for GLD. But of course, there's a chance that this is a B wave, so ABC here, because this is not overly extended, and we get a wider flat here. That's not my primary expectation for now, but of course, we have to acknowledge that potential. So base case 410, but if we start turning down from here, then watch out for a flat structure in this wave 4. So GDS gives a bit clearer signal that we've gone past this October high. We're headed towards the low 90s first, potentially even testing the high 90s in this wave 3. And that would leave us with a above 100 target for wave 5. SLV has been extremely bullish. We've got a wave 2 pullback. And now this wave 3 is hitting the 1.76 extension of this wave 1. So that's typically a more stretched territory for this wave 3. But now it looks like it could even extend to the 200% extension, so around 61 before next pullback. When a train is this fast and furious, it's best to just let it run rather than trying to preempt too much where the top might be. SIL, silver miners, it has reached our initial target zone for wave 3, around 83 to 85 level. Of course, it could extend further to 88 like silver did, like silver could be as well. And then we are looking at a pullback for this wave 4 and one more high in wave 5. And wave 5 could challenge the high 90s or even 100. Platinum. So platinum to me does look like a leading diagonal structure at the beginning of this run, where the subwaves are more divided into the ABC 3 waves. So we got the ABC here and also ABC here. So there is a case for this wave 5 also to be in the wave ABC pattern. And this wave A could go a bit higher as well. It has been pre-parabolic. If we get wave B retrace soon, that could be looking at the 50% of this wave A. So if we start moving down, that would be my target around the mid 130s level before the final wave 5. One thing you need to also watch out for is the gold platinum ratio. This is the spot levels. So gold trades at 2.2x against platinum per ounce, but that ratio actually has come down quite a bit from this 3.5 times. And the thesis is that around this range, platinum looks way too cheap relative to gold. So a lot of people are now getting into platinum. So platinum is regarded in a deep discount zone over here, and now trying to catch up here. So if you look at this chart, I think it's been more obvious why platinum has been also on a rise. And just at the same time, we're going to look at the gold versus palladium ratio too, very similar. It topped out at 3.6 and now it's trading down. So palladium could be catching up with gold in terms of performance. And one more thing before we get to the palladium chart is the platinum versus palladium ratio. So one would mean they cost the same per ounce, and above one means platinum is more expensive. So industrially, they are used in automobiles as a close substitute. So when platinum gets too expensive relative to palladium, there is a bit more demand for palladium as an industrial substitute. So there is also that dynamic to watch out for. Just getting back to the palladium chart. So palladium looks a bit more impulsive in terms of structure. We could be looking at the wave 3 here. That's now testing the 1.38 extension of this wave 1. It's just been a straight jump up since this wave 2 low in early December. And we could be topping out potentially here around the 180 area before a wave 4 pullback. But I don't think that is the end of the cycle. We should be heading higher for this wave 5. Copper. So copper has been trading in a wide upward channel. So every time it touches the top of this channel, it retraces, and the bottom of this channel has been a pretty reliable support zone here. So again, it's now on the way up towards the top of this channel, and I think that could be a wave 3 target around 37 to potentially 40 before completing this. Apple has been retracing in this wave 4 pullback that we've been expecting and tracking for a while. It's held the 50-day moving average, so that's bullish. And it could just continue this upward channel here to finish off this wave 5. I do think there should be one more high in wave 5 ahead of the earnings above 300. Assuming that wave 4 bottomed here, we could be looking at the 138 to 160 extension of this wave 4. Amazon, there is a chance that we have bottomed in wave 2 here. And now we're looking at the beginning of wave 3, but there's a lot of confirmation required. First, going above the 50-day moving average, the blue line here, and also jumping above this heavy volume traded zone here. So once we move above 230 or even 235, there's a lot less resistance in terms of the selling pressure. And I do think this large base in the past 5 months or so could create a quite significant upside in this wave 5. Google, it has more than doubled since the April low. Its valuation has moved from a negative 2 standard deviation below its 3-year average to 2 standard deviations above, meaning it's being overbought. Now, looking at this wave 4 retrace, I think this wave 4 could at least move below the 50-day moving average or retest it. And I think the upper end of this wave 4 could be 270. And I think if you look at the Microsoft chart later, Google reminds me a lot of the Microsoft price movement in the summer. Very, very steady buying throughout this period, but subsequently we got a fairly sizable wave 4 drawdown. Meta is a very messy chart. I'm near-term leaning a bit more bearish here. I think we could have had waves 1, 2, 3, 4 here. So now expecting a new low in wave 5. But even if this is not going to be a new low, and actually this is wave 1, 2 setup, I would expect a steeper retrace, at least in this wave 2 of a new bullish cycle. So I'm still very mindful and cautious about Meta. It's still below the 200-day moving average. I do think unless we can take out 710, 715 and fill the gap, I would stay cautious still. Microsoft, I think we are having just the initial rally here that's building up towards it. This wave C suffices relative to wave A of this wave 4. And I think this wave 1 could try to attack this volume region around 500 before pulling back in a wave 2. So it might be prudent to just wait for this to play out and then buying the pullback, which will likely again retest the 200-day moving average on the way down. NVIDIA's price technicals aren't that great. This first is a head and shoulders pattern, and we're trading right at the neckline. So trading below it, we're looking at a much steeper drawdown here towards 155 to 160 even, and meeting the 200-day moving average in red. Over here, there's not a lot of volume for support, so I'm a bit cautious on NVIDIA in the near term. I think it does need to prove itself, for example, taking out the 50-day moving average and this local high for us to think maybe we're headed towards a new bounce, or at least a wave B bounce towards the 200. Tesla is trying to hold this high from December 2024. So that's now a new battle area, trying to get past it sustainably. I think it will eventually, and I think we will get to 520 to 560 level in the next rally. I don't think this is a difficult target, but once we do complete this region, I do disagree with the more outlandish calls for 700 in the near term. We've had a big swing in terms of the price action from this April low. So getting above here does look a bit extended relative to this wave A. What I would favor is completing here and then by early next year, and then draw down in this wave B, which would be a very good dip buying opportunity again. Every time we have a positive price action, people don't seem to think that we can ever pull back again. But every time we have a negative price action, people think we can never rally again. So just try not to be too anchored by the recency bias in our projections. The whole point is to stay aware of both the bullish opportunities and the bearish potentials, so we can be best prepared when it unfolds. Palantir is stabilizing around the 50-day moving average. My biggest concern is that this could be a wave B retrace for a flat structure at least, and then we get one more low to challenge the 200-day moving average. It's losing a bit of momentum in this region. But of course, if it does get past this volume heavy region, get past 200 again, my bearish thesis could be invalidated, but we're not quite there yet. Finally, SOXX. SOXX has been following SPY more than it has been following NVIDIA. And we're looking at wave 2 pullback here of the large degree wave 5. So I think it's quite safe to follow what the SPY does in interpreting this chart. So that's it for this week. Thank you and Merry Christmas. My next video will likely be after New Year, when we are starting to do the beginning of the year projections. Thank you very much for the kind support you've shown over the past year, and enjoy a lovely Christmas and New Year holiday. Thank you.